Hello, everyone. My name is Igor Tomic, and today we are recording the episode of the Fintech Garden Podcast. And I'm really pleased to introduce Ronel David, who is a really diverse person with a different experience. And it's so great to highlight that Ronel right now is working as non-executive board member. Actually, she's doing a lot of work with the Money 2020 as a mentor of Rise Up and Amplify. And coming from the background from SHBC Innovation Banking, I think says a lot. So hello, Ronel. How are you today?
Good morning. I'm really well, thanks, Igor. Thank you very much for the invite. It's great to be here.
I would like to jump and discuss. We did some preparation for the episode. We discussed what we're going to talk about. And one area that I'm particularly interested is the difference and maybe the cultural gap between tier one, tier two banks and the fintechs. Because working with the decade with this industry, I see that there is some difference when you overlap, interact, talk, and even do the business with the different tiers of the financial institutions. Coming from this background, from SHBC, I think gives you a lot of insights what is happening. So can you tell us a little bit what you think, what is the cultural difference here?
The honest answer is that misunderstandings can happen on both sides. I've seen that having sat at both tables. Common one is about what success actually looks like for each party. For a fintech, success is product market fit. Users love it, it works, it scales, and they walk that into a bank and something shifts because the bank isn't only evaluating whether the product is good, it's evaluating whether it can be responsible for that product. And that's a completely different frame. And, sometimes, I guess fintechs sometimes miss that when they enter the room with that frame in mind. Another area I'd say is speed versus consequence. Fintechs operate on the philosophy that iteration is cheaper than perfection, right? You fail fast, you learn faster, and that works brilliantly in a world where the cost of failure falls on the startup. In banking, that's different, right? The cost of failure falls on the customer. There's a regulatory impact. The institution's license to operate could be impacted. A fintech outage, a worst case might be a bad press day. But for banks, that failure could be an inquiry from Parliament. And so that risk calibration, which sometimes can be perceived as stubbornness on the bank's part or slow moving, I think is proportionate. Fintechs that understand that start having very different conversations. Another one that I'm seeing, and I think we're all seeing, is the shift in the ecosystem. Banks are no longer primarily competing with fintechs, they're competing through them. That infrastructure and ecosystem layer is where the real competition is happening right now. A good example of that, and you would have seen in the press, is the Capital One Brex acquisition, right? That was announced, I think, back in January. And, if I think about Brex, they peaked at like a $12 billion valuation back in 2022. And this year, Capital One got them for $5 billion, right? When you think about it, Capital One didn't just buy a credit card product. They bought a vertically integrated financial operating system, right, for businesses. Brex had spent a lot of time building an end-to-end solution, corporate cards, and then, they laid that with AI-driven spend management. Then they've got auto-categorization and routing of approvals and links to global treasury tools, et cetera, et cetera. And I guess critically, they also had stablecoin payments capability. And then when you think about Brex's customers, like DoorDash and Robinhood and Zoom, that's enterprise distribution, that could have taken Capital One quite a long time, to build organically. And so for me, I guess the lesson that might be there is that, for mature fintech capability, buying is sometimes faster, maybe cheaper, right, and more reliable than building. You need to be patient, as they were with Capital One and Brex. It will be interesting to see if Capital One is able to preserve or innovation culture while giving it, giving the whole newly acquired entity its regulatory infrastructure and distribution scale, etc. And that cultural gap is what we're talking about today, I guess.
I'm looking on this as a spectrum, I think, because definitely different values helping businesses to do different things. And if you're, as a Brex, you're coming to the market, you should have a different mindset, which allows you to test the ideas, roll out faster to the market and kind of penetrate the market which already been there. Because Brex, let's be fair, it didn't invent any new business models or technologies. They came and they provided the value to the end client in the existing market. What is maybe the perfect balance? Because if we take a look on this as a spectrum, in one way, you cannot be really conservative because the market is shifting. It's not just about the financial technology in kind of tier one, tier two banks and neobanks, because the blockchain is allowed from any window. And then there are big techs which are coming for the piece of pie of the fintechs, like Apple is releasing the cards, Google is also moving into the payments. So a lot of things are happening. So what is it, in your view, if we will try to generalize, what is then the best balance to be as good as a banks with keeping the market, but also innovating the same way as startups or even Brex did?
Yeah, I think it's a challenge that all players are facing, and it's a really good question. I don't think there's an easy answer to that. I think it's very much, for me, going back to really understanding your clients, how your clients' needs are evolving, and have you got a really good understanding of that, and are you building solutions, that are relevant for that, whether today or future proofing that. And then based on, your size, your budget, your resource constraints, I think a very pragmatic approach needs to be taken. So it's not a one size fits all. I think you have to adapt based on your particular situation, but there isn't room for complacency. And I think it's really important because things are happening and they're happening quite quickly. And so the landscape is being reshaped, and you need to be aware of that. You need to be aware of your clients for one, but also your competitors and what are they doing, and also new capability that's coming on board. And are you doing that horizon scanning to be able to see it, to understand and know how to react in that particular situation? And so you need to have this strategic mindset whilst you're still stuck in delivering and kind of trying to just service your clients. You can't actually lose sight of the bigger picture, and I think that's really important for all players to keep in mind.
That's the hardest thing that you can imagine. Keep doing the things on tactical level and keeping the strategical overview and not lose the side where you want to go. Like maybe a little bit of insights, like what helps the banks to do that? Because it feels sometimes that banks, they have the business model, they have the clientele, they have the channels, some monopoly or the established market share. And sometimes it feels like for banks, and especially high tier banks, it's really easy to assume something which is not happening in reality. So what are maybe the methods or approaches that tier one, tier two banks are doing to keep with the reality, understand what are the real needs of the customers?
What fintechs sort of lack in understanding about how banks really evaluate these partnerships. Fintechs kind of come in and they think they're making a sale, and they're really excited because it's a tier one logo and, it's going to help them to really cement their position in that space. But banks, yes, they want to solve either for a problem or to create a growth enabler. But equally, they think about it from a risk and a governance perspective as well. And so, yes, understanding the client is really important, but also understanding how they need to move and operate within the framework that a bank needs to do that in. And those different perspectives are sometimes almost incompatible at the start. And the partnership process, for me, successful partnership process, is really about closing that gap. Think about a scenario, right, that could actually happen in reality. A fintech has this great solution, they have a proposal, it lands on someone's desk, maybe the innovation team within a bank. The innovation team loves it. And then that proposal goes through the organization, right? It travels to legal, to infosec, to operational risk, to data governance, to procurement, enterprise architecture, all sorts of roles, because these banks are just huge and not easy to navigate, firstly. And just having this awareness of their complexity is important. And then at each stop in that process, a completely different set of questions are getting asked. But usually the fintech has only come prepared for answers to questions from the first room, not all those rooms, right? The other is, I think, when it comes to the language that each team speaks, I think sometimes we're saying the same words, but they mean different things. So, like, take an API as an example, right? I think you and I talked about fintech says, we have an API. It's it's beautiful. It's easy integration. Your team can be live in weeks. And they're saying that, but the bank is hearing something different, right? They're saying you want a direct connection to our core systems. You want access to our customer data, our payment rails, and you're asking us to move in weeks. That's a very different conversation that each one's having. It's about an API, but it's very different perspectives of it. So it's not just a technical concept, not just something elegant and well documented and fast to integrate. To a bank, that same API mean, a liability, a question around that. Who owns the data flowing through it? What's the SLA if something goes wrong? What's the exit strategy if the fintech gets acquired like Brex was? Which regulator do we call in a breach? And what does that operational resilience framework look like under DORA, the EU's Digital Operation Resilience Act? So it's not just technical anxiety, that's actual governance. That's what governance looks like in a bank. And, we talked about the complexity that exists within banks, but there's also that internal political landscape that exists, right? So you might have the innovation team that got the proposal in the first place and is being this champion of the solution in the organization, or trying to be, but that person is not typically the same person with the budget authority. The CTO might come in and he may be supportive, but ultimately it might be that, the chief commercial officer has the veto power in the end. I've seen deals sometimes die, but not because anyone said no. It's died because the person that fintech was speaking to didn't have the authority to say yes. And the fintech didn't know how to actually navigate the organization to actually find out who that person is that they actually need to be speaking to. I guess it's not an easy answer, but you got to take these complexities into mind when you're thinking about it.
I've been thinking about those complexities a lot. And as Dash Devs, we interacted with the NatWest. And it's a great experience because you understand there are a lot of different flows. And we worked with the product owners, we delivered the stuff, but then procurement and even purchase order is working asynchronously. So sometimes it's not coming hand in hand. But I'm thinking about the good analogy for that. And it feels like sometimes fintechs, they think that doing the home dinner for the family is kind of the same size as feeding kids in the school, because it's kind of regulated. You cannot mess up. You cannot do the things which will throw away all the hard work from a lot of people, because one mistake, diary, which doesn't work well, will ruin everything. So, and coming and saying, yeah, we've done it once. We fed 4 people and we okay to take a scale, 4,000 kids. It's not the same. And understanding that if the team and the roles in those teams are really different, because in a family you can say, okay, now you're chopping, now you're doing the stuff, but it doesn't work with the large scale. So understanding that sometimes someone from the cooking team is okay with your products, but it doesn't mean that it fits into the whole process large scale. And I think that's important area. In my experience, it's not coming from bad incentives. It's coming because the banks has been on the market for years, and especially in the United Kingdom, like the usual retail banking license is 200 years old. It means that there is a proven effect that the things that has been happening on the bank side, they've been in a good way because the banks keeping growing, they serving their clients, and everything is stable and moving as required. That brings us into the element with AI, because like the landscape is dramatically changed. If I take a look on my IT experience starting from 2000s, the world has been different. Like right now, in one day, you got more messages, information coming than it used to be in a month. The velocity, the speed of the communication, the speed of the needs are different. And right now, we're AI knocking is the door, because we basically living in a moment when the LLMs, like it just right now, the language models, but they're coming from every window. Like you opening the website of the banks and there is a chat, which you can ask to write a poem or something. What do you think is AI in modern like context with this human element is something that will affect both sides as a fintechs and tier 1, tier 2 banks?
I guess the reason all this matters more urgently now is because of AI, right? It is absolutely, and I agree with you on all of those points. AI is accelerating pace at which these decisions need to be made as well. But it's also amplifying, I guess, the consequences of getting them wrong, right? And so when I think about AI, I always, try to think about the human element that needs to go with that. I don't think it's a matter of balance anymore, because I think that word just implies that there's a scale where more AI means less human, or vice versa. And I don't think that's the right model. And I was thinking about, what word makes sense to me right now. And I think the word is what we need is placement, knowing precisely where a decision chain AI should operate, where a human needs to be accountable for the outcome. Fraud detection is a really good example of where AI is being used very successfully. I would say it's one of the areas where, it's really made an impact in financial services. It's faster, it's more accurate, than any human analyst. And it operates at a scale that no team can match, right? And when it does go wrong, because sometimes it can go wrong, I think there is a reasonable mechanism to correct it. The consequences, like of having false positive, they can be recoverable. You can flag a transaction, you can make a customer call and, try to figure it out. But if you think about credit decisions, that all lenders having to make, AI in that context, could exclude someone from financial services. Or it could lead to a customer complaint that involves real financial hardships, or to a risk model that determines whether a small business, an SME, gets an account or not. And the accountability stakes, I think, different, because these aren't just technical decisions. They have a human consequence that are sometimes irreversible. And sometimes, you may not get the loan, or business won't be able to function, or someone might not be able to pay their rent because something's gone wrong. And from a governance perspective, we have to ask, like, what happens in this AI-driven decision if that goes wrong? What happens, and it happens at scale. Because at some point, something eventually does go wrong. And then who is, wearing my NED hat here, who is the named person that's being accountable for that outcome? It's not the vendor, it's not the data scientist, it's not the, can't blame it on the model, an actual person whose name appears in, say, the board minutes, right? So most institutions don't have a clean answer to that. As regulators get more sophisticated, which they are doing and fast, the ones without that answer are going to find themselves in a very uncomfortable conversation. Especially, I guess it becomes very important when you consider the specific responsibilities that AI, just structurally cannot absorb, no matter how capable it becomes.
Having the AI responsible for certain processes doesn't make it accountable. I've been thinking for years about those two different processes, because accountability and responsibility totally different in nature. You're doing something, but someone accountable is owning the outcome of the result. And it still puts a lot of pressure on the banks, the technology teams, the business teams, to make sure that they own in the accountability, although using AI tools as responsible for the specific process. Even, I don't know, let's talk about the support chat or AI agent is talking with the client, but the bank's still accountable for the outcome, to not disclosing another client information, to provide the accurate data, accurate answers and results. So I think it's a good point here that the future line between AI automation and data is actually, or basically the models, is laying between properly putting the accountability on humans, putting the responsibility on certain business processes which can be automated. Thank you for highlighting. That's really good and interesting outcome that I think is important for this episode. It shifts to another topic that I wanted to discuss today is talent and market distribution, because that comes play along with those innovations. Different profiles becoming more important to both sides, because we used to write the code like manually. There are a lot of vibe coding, which doesn't shift the accountability for outcome anyway. But what do you think about the changes into the talents and the ability to attract those talents for different stakeholders as banks or fintechs?
Yeah, and I think particularly with banks restructuring right now, it's definitely creating an interesting moment that I think fintechs are only maybe half capitalizing on. So what's happening at the moment in global banking? There's restructuring, post acquisition type integration, absolutely, AI and automation, and that displacement that you're seeing there. And the result of that is thousands of highly experienced professionals, specialists across payments, treasury, lending, who are either being exited or voluntarily stepping back and asking, what's next? These people know things that take years to learn, right? And I'm not trying to toot my own horn here, but they know things like, why a Swift message fails at 1 a.m. in the morning. They know what a credit committee, actually looks at beyond a scorecard, for example. They know the unwritten kind of rules, an example like in procurement, for example, or the hierarchy of approvals that's needed, or the language that it takes to get a sign off internally. And that institutional knowledge is kind of hard to sometimes quantify, but it's exactly what those fintechs are missing when they try to break into enterprise or into bank partnerships, or the big first deal. And when I'm personally building on this insight right now, because I do quite a bit of board advisory work with fintechs, and connecting that deep banking and technology experience with fintechs, all the way from ideation and product build and product market fit and good market strategies and roadmap development, etc. Looking at client mapping, that journey and experience building that competitive moat, which is really important. And so, I've been leveraging my experience in that way, not as a consultant who will write a report and kind of walks away, but as someone that's embedded on these advisory boards, acting as a bit of a reality checker, right? And I think you need that, to be able to say, well, here's what the bank will actually ask when they read this proposal, or have you factored this into your procurement timeline, or really who has that veto power in that institution? And that knowledge shortcut is worth quite a lot, and more than fintechs realize. And are they doing enough to then tap into this growing pool of bankers or ex-bankers, right, that are now in the market?
And I have a really interesting saying that I heard from American business associations. We are doing it not because it's easy, we're doing it because we thought it's easy. And overlapping with your overview, I think sometimes fintechs, they're missing an understanding what is happening in reality with the banks, with the industry, why buy now, pay later is not just onboarding and KYC the customer. It's properly to understand who's eligible for the revolving credit, how to do the debt collection, how to work with the edge cases, because not everyone is paying the debts. And then even sometimes there are specific attacks on the buy now, pay later to accumulate the money and use them, even though people are knowing that they financially attacking the institution. So that gives a lot of insights that we kind of need to redistribute the knowledge, how the things are working for real, from technology side back to banks maybe, and vice versa, from the business perspective back to the startups. And that what makes the ecosystem grow faster and more reliable, I think.
I'll add to that and say that, these experienced, kind of ex-bankers, they can help bridge the gap, help fintechs to make better and decisions, and help those banks to make better decisions as well. If I think about the Brex deal, I think that's a really good story of how it's worked well, because I think there's a little bit of thinking around, bankers have this old way of thinking, but you've got to separate that kind of perception from the deep knowledge that they have. And a lot of founders kind of understandably want to break away from traditional banking culture and create a very sort of an innovation-led culture, which doesn't normally exist in banks. But experienced bankers, they know the internal anatomy of a bank, like we spoke about. And there's a difference between, disrupting a business model and throwing away 20 years of operational knowledge, I think. And maybe I'm a bit biased in this, but definitely knowledge that fintechs are missing out on. When they're stuck in year 2 of a strategic partnership that hasn't gone anywhere, they really need to think about how they've maybe approached that and what might have helped to accelerate and make that more successful.
Actually, I've got this story about the Brex, which is kind of highlighting the things that you're saying, because Brex started, they expanded really fast, but then COVID hit it. And then Brex did the introduction of the fees that no one was expecting, and they were delaying the payments because I assume they were using overnights to cover the operational risk. And it kind of shows that you built a successful story for onboarding customers, business which is doing distribution for the payrolls, but it wasn't good enough for the stress testing, which is usually nature and DNA of the banks, because usually the large institution, which is working for 200 years, it's not thinking what is going to happen in 30 days. It's the question, how bad the things can be going in 5 years, what is the resilience plans, what are the disaster plans, which is not just technical. The situation with the Brex showed they were not thinking about that, by changing on the fly the rules and ability how the customers operate in. So when the overnight success seems to be overnight success, it's not that. Certain decisions were made, some good, some bad decisions, and sometimes like having this operational experience for decades help to eliminate or at least say out loud though those things might happen, even if your company existed, I don't know, for 3 years and never experienced those things. Because if you're living long enough, you've seen a lot of things that young generation potentially haven't seen or even thought about.
Brex scaled as a pure play fintech, right? But at a certain point, it needed a license stack, needed a mature risk framework, and it needed distribution at a bank scale. And looking at Capital One, they were the opposite. They needed that integrated, solution, AI driven, that was, and the talent that built it, right? And bringing that together isn't just about buying code, right? It's taking two different decision making cultures and trying to make it one. And I think the people who will be able to make that work are the ones who will be able to speak languages that both can understand, because they've sat in both, Otherwise, it becomes really hard to really make sure that the synergies that you see from these acquisitions get materialized. And people who understand, how that works is going to be important, because, I think about when I was at FIS and the WorldPay acquisition, right? And that's a different story, but yeah.
Yeah, but there are good and bad stories in the market always. Even certain startups, they started and they failed hard, and it's happening because nothing is promised for anyone in this world. It's just the game. And coming back to your mentorship experience, because you've been deeply involved in mentorship initiatives like Money 2020, Rise Up, and Amplify programs. For your perspective, what progress the fintech industry has made in supporting women underrepresented groups, and where the biggest gap exists?
So I want to be honest, right, rather than just maybe encouraging, because the industry, tends to celebrate progress sometimes too early and then stop maybe doing the work, where I feel like there's still a lot more work to be done here. The genuine progress is being, yes, entry and mid-level representation has improved meaningfully, right? Particularly in areas that there definitely were lack of women, like say in product or technology. And of course, in other areas like customer experience, where women have always had a strong representation. The work that I've been doing, like with Money 2020 and the Amplify and Rise Up program, I feel is really important. And the reason I do it is because I feel it creates real access, real visibility, real mentorship and network, right? And in some cases, direct, career privilege can be attributed to these programs. And when I mentor to them, I'm in rooms with people whose ideas are sharp and whose lived experience is, directly relevant to the problems that fintech is trying to solve. And that pipeline is real and it's growing, and it's very encouraging. But at the C-suite level and at the boardroom level, I think it's still sobering, right? Women hold under, I think I read a stat that was like under 20% of fintech board positions globally. And founders from underrepresented backgrounds receive a tinier fraction than women do, right, when it comes to VC funding. And I guess we're doing this in relation to their white male counterparts, right, and thinking about historically who would get access to that. And despite, I guess, all the initiatives and maybe the visibility that is getting, the gap hasn't really moved a hell of a lot, in the past. I wish it had, but it hasn't. And I guess another area to think about is, which I don't think we often talk about, is retention. So getting people into the role is only half the job, right? If the culture at the top is still exclusionary, if women are penalized for leadership styles that maybe don't mirror the norm, if assertiveness is read as aggression, often women are labeled as that. If collaborative decision making sometimes reads as indecision, if professionals like from certain nationalities or backgrounds hit invisible ceilings, that talent pipeline becomes a conveyor belt that delivers people straight out the back door, right? No one's going to stick around very long, and you're going to have this churn in the business. So yeah, I think if I'm being really honest, there's still a lot more work to be done. The inclusion conversation in fintech, we need to explore that further.
And I think I've seen, at least from my perspective, when interacting with the fintechs in United Kingdom, visibly you can see that at least the questions are there. maybe inside under the hood, the things are moving slower that we would want to. But in reality, you see a lot of initiatives for women jumping into the technology, education for the financial stuff, and even an example with the Money 2020. I think they're doing really great job by starting those programs, and it shows that there is at least incentive, which takes time, but I think it will have own seeds grown with a specific time.
Absolutely. And it's unfortunate because, thousands and thousands of women and underrepresented people apply for that every year. But the program can only cater to a small proportion of that. And so the ones that are getting through, they have an amazing opportunity to really have access to all of that. I just wish, we could do more. And I wish more organizations would get behind this, make meaningful connections and support these underrepresented talents and founders a lot more. I think we'd have greater or better outcomes because of that. And it's not just fintech. I want to make sure it's everyone in financial services, right? It's not just a fintech problem.
It sounds like we can dedicate the whole episode about the inclusion and what is happening there, because it's really important topic. And I think one of the reasons why Fintech Garden is started to educate people, because the knowledge is something which is surviving when you're sharing, and having the verticals which are not given us ability to educate people. And the best way to educate is actually do the things which is connected with the given ability for underrepresented groups and women to do a lot of more things, because they're definitely capable of. So I think maybe we should think about the whole episode about that.
We haven't truly, overcome bias, right? And when it comes to either gender, nationality, or background. And I think saying otherwise would be wrong. It would be counterproductive, because then it stops us doing the work that's needed. And part of it, I think, has got to do with this, like the way we view ourselves, the self-image, right? As a fintech, you like to think that you're open, you're progressive, you've got this different brand that you're creating. It's a lot of talk around financial inclusion, etc. And yes, you are solving for lots of things, right? And many people genuinely, believe that in the industry and try to live it. And so I think there's some great examples of that. But belief and structural reality are different. Structural bias doesn't require bad intent. It's not always about going in and someone is really trying to be mean. I think it just happens. It reproduces itself, through familiarity, patterns, and who gets the benefit of the doubt in the room, basically. And I've, as a woman of color, as a woman who's not British born, so I'm South African, and I have an accent, and I can tell you that the reception to the same idea changes depending on who's delivering it, right? That's the reality. Same idea, different face, different responses. And that's not unique to fintech or financial services. But, I think that as a sector, we haven't actually addressed this with enough structural rigor that it can sometimes come across as.
That's right. And coming from Ukraine, also, English is not a native language. Everyone can feel that you're using it, but delivering the same stuff, sometimes it doesn't feel like a be same of the kind, because it's really important for doing business and pitching the idea and then having the doubts, et cetera, doesn't help a lot. So yeah, let's think about the whole episode about that. And since we are approaching the end, I'm usually asking the question, what you would like to answer that I didn't ask today.
Fintechs, encourage them to learn to speak bank talk before they walk into the real room, right? Don't just lead with technology, lead with the bank's problems. And those problems could be anything from, an NPS score that's really bad, regulatory pressure that they're having, or strategic priorities that they might have for the year. If the bank is focused on operational resilience and you're pitching innovation, you're kind of out of sync before you started, right? And discovery sessions are really important. They don't fail because the ideas are bad. They fail because either side hasn't really done the homework in terms of understanding the language that needs to be spoken. And be realistic, about timelines and resourcing. A bank partnership, can take anything from 9 to 18 months from the first conversion to maybe having, a POC go live. You need to budget for that. You need to staff for that. You need to have enough financial runway for that. When you're pricing that, make sure you're doing it in a sustainable way, because the bank needs a partner that's going to be around for a long time and not go under because their pricing has not been done in a sustainable way. Think about these different things. Think about having maybe a dedicated relationship owner who understands the banks, the internal policies. And talking about pricing, I think banks are increasingly getting comfortable with outcome-based or revenue share models, right? Because it aligns to the incentives. And sometimes having a flat license fee, which doesn't flex with usage, makes people uncomfortable, makes procurement nervous. And if you're asking a bank to change their behavior, reduce their risk in that commercial model if possible. And I guess for the banks, on the other hand, it's an opportunity to really co-create, not to just procure a solution or a service. The most successful relationships or partnership relationships are ones that I've seen where, the bank is a design partner, not just a customer. And that means like putting your product people in the room with the fintech during the build, not just at the end for user acceptance testing. It means sharing data about client pain points. You can do that under an NDA to make yourself get comfortable with that. You leverage the CVCs, the corporate venture arms, right? They're not there just to write checks, but they give fintechs a real strategic signal about what problems the banks actually need solved, because they've got a good understanding of that, and they're reviewing what's out there to see what's a good fit. So definitely leverage that. So I'll stop there.
Yeah, it's a really good insights. And I'm thinking about co-creation is always the winning path, because instead of just doing it transactionally, learn how to work together and create the results that benefiting from both sides. It's not really win-to-win situation. It's more, how do you educate yourself to make the customer more successful? It's kind of you're winning as a vendor than even more than the company which is taking the service, and which is true for the banks, because you will see the scale, you will see how the decisions are made, and then you will see how the customer are benefiting, which is much more even important sometimes than money, because the knowledge sometimes you cannot buy. Thank you for this really warm and lovely discussion. I've got a lot of insights and takeaways for this episode. And thank you everyone for listening to us till the end. And Ronald, once again, thank you for your time.
Oh, it's my pleasure. Thank you for having me.